Welcome to the Duck Dive. Today, we're tackling something really key for, well, any business, really, managing interest rate risk. We've gathered some great source material for you, including parts of a financial management study guide on hedging techniques.
That's right. And our mission here, is to really pull out the most crucial bits of knowledge. How do businesses actually navigate these choppy waters of interest rate changes? We want to help you understand what's truly essential.
Exactly. Because, as we'll see, when a business doesn't know its future interest costs or earnings, it's not a small thing. It really impacts cash flow forecasts, project decisions, the whole lot. So let's maybe start at the beginning. What exactly are we talking about when we say interest rate risk?
Well, at its heart, interest rate risk is really just that uncertainty businesses face about, how much interest they'll end up paying on loans, either existing ones or ones they plan to take out, or how much they'll earn on deposits.
Right, the not knowing. And why is that such a big deal for a company's planning?
Well, think about it. This uncertainty can, frankly, cripple their ability to create accurate cash flow forecasts. It shakes confidence in those big project appraisal decisions too, because changing interest rates mess with the weighted average cost of capital, which then impacts things like net present value calcs.
That sounds pretty serious. I remember reading in the source, if a company takes on variable rate debt when rates are low, a sudden spike could even lead to liquidation if they just can't make the payments anymore.
Exactly. And what's really fascinating here, and a key takeaway, is that managing this risk isn't actually about always getting the absolute lowest interest rate possible.
Oh, interesting. So what is the main goal then?
It's about limiting the uncertainty. It's about creating predictability so the business can plan with more confidence. Stability over, let's say, chasing the absolute best rate.
Okay, predictability. That's a really important distinction. So let's explore some of the maybe more traditional or basic ways businesses tackle this. The source mentions that fundamental choice, fixed versus variable rates.
Yeah, that's often the first decision point, isn't it? When you take out a loan or make a deposit. Variable rates, or floating rates as they're sometimes called, are typically linked to a benchmark. Something like SONIA, the Sterling Overnight Index Average. So your rate might be, say, SONIA plus 3%.
Right. So if you go for fixed, maybe a $2 million loan at 5%, costing $100,000 a year, you're protected if rates shoot up. But what's the catch?
The catch is you won't benefit if interest rates fall. You could be stuck paying, say, 5% when new loans are available at 3%. That could put you at a disadvantage compared to competitors. And same logic applies to deposits. You might miss out on better returns.
Okay, that trade-off makes sense. Certainty versus potential benefit. Now, what about this idea of smoothing? What's that involve?
Smoothing is, it's a pretty straightforward idea. It's basically diversifying your interest rate exposure. A business might decide to have, say, half its debt at fixed rates and half at variable rates.
Ah, okay. Like not putting all your eggs in one basket.
Precisely. So if rates go up, only the variable portion gets more expensive. It softens the blow compared to having everything variable. There isn't necessarily a complex science to it. It often comes down to what the business feels it can afford and, their best guess about where rates might be heading.
Got it. And then there's matching. How does that work as a strategy?
Matching is about trying to align your assets and liabilities that have the same type of interest rate structure.
Sure.
So variable rate assets against variable rate liabilities, ideally aiming for the amounts to be pretty close.
Right. Can you give us a quick example to make that clear?
Sure. Let's imagine a business has deposits earning SONIA plus 1% and borrowings costing SONIA plus 4%. Let's say they have $500,000 on deposit and $520,000 borrowed.
Okay.
Now, if SONIA is, let's say 3%, the annual interest they pay is $520,000 times 3% plus 4%, which is 7%. That's $36,400. The interest they receive is $500,000 times 3% plus 1%, or 4%. That's $20,000. So their net cost is $16,400.
Right, the difference.
Now, what if SONIA jumps by 2%? Up to 5%. The interest paid becomes $520,000 times 5% plus 4%, or 9%. That's $46,800. But the interest received also goes up. $500,000 times 5% plus 1%, or 6%. That's $30,000. But the interest received also goes up. The new net cost, $16,800.
Wow. Okay. So the net cost barely changed. The huge jump in interest paid was almost completely canceled out by the jump in interest received. That extra $400 is just related to the small mismatch in the amounts, the $20,000 difference.
Exactly. It really shows how effective matching can be in neutralizing the impact of rate changes on your net interest expense or income.
That's very clear. Now, moving beyond just the rates themselves, the source also talks about asset and liability management, focusing on the timing or duration of loans and deposits. How does that fit in?
Yes, that's another layer. Even if you have fixed rates, if your assets and liabilities mature at wildly different times, you can still run into trouble. Well, take the example from the source. A company gets a 10-year fixed-rate mortgage at 6% to buy a property. They then rent out that property, but maybe only on a 5-year lease, getting an 8% yield initially.
Okay, sounds good for the first 5 years.
Right. But what happens after 5 years when the lease is up? If market rental yields have dropped to, say, 5% when they sign a new lease, suddenly their income, 5%, is less than their fixed mortgage cost, 6%. They start losing money, even though the rates were fixed.
I see. So the smarter move would have been to try and match the loan term more closely to the lease term, or at least be prepared to refinance.
Exactly. Matching the duration allows them to reassess both sides of the equation around the same time. If rates had fallen after 5 years, they might have been able to refinance the remaining loan at a lower rate. It's about aligning the timing of your commitments.
Okay, that makes sense. Let's shift gears now to some of the more specific financial instruments, forward rate agreements or FRAs. These sound like they're designed to lock in a future rate directly.
That's precisely what they do. An FRA lets a business agree today on an interest rate that will apply to a loan or deposit for a specific period in the future.
And the notation like 312 agreement, what does that mean?
Good question. A 312 FRA means the agreement covers an interest period that starts in 3 months' time and lasts for 9 months, ending 12 months from today. It defines the start point and the end point of the period being hedged.
Got it. The source had a good example with a company called NeuroCo. They needed to borrow $2 million in 4 months for a 3-month period. They were worried rates would rise from the current 5%. A bank, Helpy Bank, offered them an FRA at 5%. What kind of FRA is that?
Okay, so starting in 4 months, lasting for 3 months, that would be a 4-7 FRA. Starts month 4, ends month 7. And the agreed rate is 5%.
Right, a 4-7 FRA at 5%. So let's play this out. What happens if the actual market interest rate jumps to 6.5% when NeuroCo takes out the loan?
Okay, so NeuroCo borrows the $2 million from their actual lender, Goodfellows Bank, at the market rate of 6.5%. For 3 months, the interest cost is 2 meters times 6.5% times 312, which comes out to $32,500.
Okay, that's the actual loan cost.
But because they had the FRA with Helpy Bank compensates them for the difference between the market rate and the agreed FRA rate. So Helpy Bank pays NeuroCo $2 times 6.5% minus 5% times 312. That's $7,500.
So the net cost to NeuroCo is the $32,500 they paid minus the $7,500 they received.
Which is $25,000.
Okay. Now, what if rates went the other way? What if the market rate fell to 4% when they took the loan?
Right. NeuroCo borrows at 4% from Goodfellows Bank. The interest cost is $2 times 4% times 312, which is $20,000. Much lower.
But what about the FRA? The market rate is below the FRA rate now.
Exactly. Now, the FRA works the other way. NeuroCo has to compensate Helpy Bank because the agreed rate, 5%, is higher than the market rate, 4%. So NeuroCo pays Helpy Bank $2 times 5% minus 4% times 300 day 12. That's $5,000.
So their actual loan cost was $20,000, but they had to pay $5,000 on the FRA.
Making their total net cost $25,000 again.
That's really striking. So whether rates went up to 6.5% or down to 4%, NeuroCo's effective cost was locked in at $25,000, which is exactly $2 million at the agreed 5% for 3 months.
Precisely. It perfectly illustrates that point about certainty. The FRA delivered a known cost, eliminating the uncertainty, even though it meant they didn't benefit when rates fell. You pay for that certainty.
It really drives home that the primary aim isn't always about getting the lowest rate, but about being able to plan.
Absolutely. And this naturally brings us to think about even more sophisticated tools. What if businesses want different kinds of protection or flexibility? That's where we get into interest rate derivatives.
Okay, so things like futures, options, swaps.
Exactly. We can talk about interest rate futures, options, then structures built from options like caps, floors, and collars, and finally, interest rate swaps.
Great. Let's start with interest rate futures. How do they work?
Okay, futures are standardized contracts. They're for a fixed amount, like $1 million or pounds, and a fixed duration, usually 3 months. They're traded on exchanges like IC Futures Europe. Owning a futures contract effectively creates an obligation related to a future interest rate.
An obligation? How so?
Well, simplifying a bit, selling a future is like creating an obligation to borrow at the rate implied by the futures price. Buying a future is like creating an obligation to deposit at that implied rate.
Okay. Now, the source highlights a really critical point, the inverse relationship between interest rates and futures prices. As market interest rates go up, futures prices go down. Can you unpack that? It seems counterintuitive at first.
It does, but it makes sense when you think about what the future represents. Imagine a futures contract implies an interest rate of 5%, and that matches the current market rate. Its price might be, say, 95, often quoted as 100 minus the interest rate.
Okay, 100 minus 5 is 95.
Right. Now, if market interest rates rise to 6%, who would want to buy a contract that effectively locks in a 5% deposit rate when they could get 6% elsewhere? Fewer buyers, so the price has to fall, maybe to 94, 100 minus 6.
Oh, okay. Less demand pushes the price down.
And conversely, if you're a borrower facing 6% in the market, the idea of selling a future that locks in a 5% borrowing rate looks pretty attractive. More sellers also push the price down, so higher rates mean lower futures prices.
Got it. So how do businesses use this? The summary rule mentioned is, if you're depositing, you buy futures, then sell. If you're borrowing, you sell futures, then buy.
Correct. It's about setting up a parallel transaction in the futures market to offset what happens in the actual cash market. Let's take a borrower who fears rates will rise.
Okay, rising rates mean higher borrowing costs.
Right. So to hedge, they would sell futures now when the price is higher. Current rates are lower. Later, when they actually borrow, if rates have indeed risen, their borrowing cost is higher, but the futures price will have fallen. They can then buy back the same number of futures contracts at that lower price.
Sell high, buy low. So they make a profit on the futures trade.
Exactly. And that profit on the futures transaction helps offset the higher interest they're paying on their actual loan. The goal is that the net effect, the loan cost plus or minus the futures gain loss, remains stable, close to the rate they locked in initially.
Okay, so futures provide stability through this offsetting mechanism, but you mentioned options offer more flexibility. They're described like insurance policies.
Yeah, that's a really good way to think about them.
Oh.
With an interest rate option, you pay a premium upfront, like an insurance premium, and this premium is non-refundable.
Okay, so there's an initial cost.
Yes, but in return, you get the right, but crucially not the obligation, to buy or sell futures at a specific price, called the strike price, on or before a certain date.
Right, but not obligation. That's the key difference from futures.
Absolutely. So if interest rates move against you, you exercise your option to get protection. But if rates move in your favor, you just let the option expire worthless. You lose the premium you paid, but you benefit fully from the favorable move in the market rates.
Let's walk through that for a borrower again. They fear rates rising. With futures, they sell. What do they do with options?
A borrower fearing rising rates wants protection if futures prices fall. So they would buy a put option on futures. A put option gives them the right to sell futures at an agreed strike price, let's say 95 again.
Okay, buy a put option.
Now, if market interest rates rise, the futures price falls, maybe to 93. The borrower's actual loan cost goes up, but they can now buy futures in the market at 93 and immediately exercise their put option to sell them at the strike price of 95.
Buy at 93. Sell at 95, they make a gain of 2.
Right. And that gain helps offset their higher borrowing cost.
Yeah.
But what if interest rates fall?
Okay, rates fall, good for the borrower's loan cost. Futures prices would rise, say, to 97.
Exactly. Now, the borrower has this put option, giving them the right to sell futures at 95. Would they exercise it?
No. Why sell at 95 when the market price is 97?
Precisely. They just let the put option expire. They lose the premium they paid for it, but they get the full benefit of the lower interest rate on their actual loan.
So it really is like insurance. You pay the premium. If disaster strikes, rates rise, the insurance pays out, the option gain. If things go well, rates fall, you don't use the insurance, you just enjoy the good fortune minus the premium cost.
That's it, exactly. Heads you win, benefit from falling rates. Tails you're protected, gain offsets rising rates, but you always pay that upfront premium for the flexibility.
Which naturally leads into caps, floors, and collars, right? They use these options.
Yes, they're basically strategies using options to achieve specific outcomes. A cap, for instance, sets a maximum interest rate for a borrower. It essentially involves buying a series of put options or specifically caplets, that pay out if the reference interest rate goes above a certain ceiling level. If the rate stays below the cap, the options expire worthless and the borrower just pays the lower market rate.
Okay, so a borrower buys a cap. What about a floor? That's for lenders or depositors.
Right. A floor sets a minimum interest rate for an investor. It involves buying call options, or floorlets, that pay out if the rate falls below a certain floor level. If the rate is above the floor, the investor gets the higher market rate and the options expire.
And a caller just combines these two.
Yep. A caller uses options to keep the interest rate within a specific range, a floor and a cap. A borrower wanting to limit their maximum rate but maybe reduce the cost of the cap could buy a cap and simultaneously sell a floor.
Sell a floor. Why?
Selling the floor generates premium income, which helps offset the premium cost of buying the cap. Of course, by selling the floor, they give up the benefit if rates fall below that floor level, so they create a collar. Their rate won't go above the cap or below the floor.
Okay, trading away some potential upside to reduce the cost of downside protection.
That's the essence of a collar. A depositor can do the opposite, buy a floor and sell a cap.
Got it. Finally, let's talk about interest rate swaps. These sound like a more direct exchange.
They are. An interest rate swap is an agreement between two parties to exchange interest payments based on a specified notional principal amount for an agreed period. They don't usually exchange the actual principal, just the interest calculation differences.
And how are they typically used?
Very common use is to hedge. For example, a company with variable rate debt might swap its variable payments for fixed payments, effectively converting its debt to fixed rate, or vice versa. They can also be used just to achieve a desired mix of fixed and variable rate debt in their portfolio.
Now, one thing the source mentioned was quite interesting. Swaps can sometimes allow both companies involved to get better rates than they could get on their own directly from a bank. How does that work?
It often comes down to what's called comparative advantage. One company might have a better credit rating and easier access to, say, cheap fixed-rate funding, while another company might have better access to variable rate funding.
Okay, different strengths.
Right. So they can borrow in the market where they have an advantage and then use a swap to exchange those payments, effectively letting both parties benefit from the other's advantage. A bank usually acts as an intermediary, arranging the swap and reducing the risk of one party defaulting. The most common type is the plain vanilla swap, just exchanging fixed for floating rate payments.
And the source also noted swaps can cover longer periods than, say, futures or options, but they lock you in. You don't get to benefit from favorable rate moves like you might with an option.
That's a key characteristic. Swaps offer longer-term certainty, but less flexibility than options. You fix the exchange. And just to mention it, there's a related instrument called a currency swap.
Yes, involving different currencies.
Exactly. It's like an interest rate swap. But the interest payments and usually the principal amounts at the beginning and end are exchanged in different currencies. Very useful for hedging exchange rate risk on foreign currency loans, like swapping fixed dollar debt for fixed euro debt.
Wow. Okay, that was a really comprehensive run-through. We started with the basic problem of interest rate uncertainty, looked at foundational tactics like fixed variable, smoothing, matching, and duration management. Then dived into the derivatives. FRAs for locking rates, futures for offsetting gains and losses, options for flexible insurance-like protection.
And the strategies built on them, like caps, floors, collars.
Right, and finally swaps for exchanging payment streams, often over longer terms.
And I think the thread running through all of it, as we said at the start, is that the main goal is usually about managing that uncertainty, providing predictability for planning, rather than just purely chasing the lowest possible cost or highest return. It's risk management, fundamentally.
Definitely. So thinking about all these tools and trade-offs, the certainty versus potential upside, the upfront costs of options versus the rigidity of swaps, how should businesses, listening to this, really approach deciding which mix of these strategies is right for them, especially when the goal is stable planning, not just rate optimization?
That's the million-dollar question, isn't it? I think it boils down to really understanding your specific exposure first. Are you more sensitive to rates rising or falling? What's the time frame? Then assessing your genuine risk appetite. How much volatility can the business comfortably handle? And finally, it's about weighing the cost versus the benefit of each tool. Simpler methods like smoothing might be enough for some, while others might need targeted derivatives for specific large exposures. Often it's not an either, it's about layering different approaches intelligently.
Layering approaches, that makes a lot of sense. Combining the tools strategically.
Exactly. There's no single right answer. It depends entirely on the company's specific situation, its forecasts, and its tolerance for risk.
Well, that's a great place to leave it. Some fascinating things to consider. We really hope this deep dive has helped clarify this really critical area of financial management for you. Join us next time for another deep dive.